Hi, this is Manish Jain from Mirae Asset Capital Markets India. I am Director Institutional Business, heading equity and fixed income desks, including sales and research. I have about 2 decades of experience. Before MACM India, I had worked with Axis Capital and Mitsubishi UFJ Morgan Stanley. Investors looking to invest in a country should be asking 3 questions. Does the market has cushion against external, internal volatility? Is the currency stable so that investment returns are attractive in dollar terms? Is the economy on a consistent secular growth path, or it's just a flash growth which can vanish in some time? Let's look at the opportunity called India. Domestic institutional investors or DIIs used to net buy $9 to 10 billion 10 years back and $11 to 12 billion 5 years back. This year YTD basis, DIIs have already net bought $20 billion. This figure was $35 billion in 2022. Systematic investment plan per month is $2 billion, which is $24 billion per year. The SIP book has been growing on an average by 2% month on month for last 2 years. Now foreign money flow. A few years back, if foreign portfolio investors used to withdraw a few USD billions from Indian market, the correction used to be very sharp. This year, YTD basis, FPIs have withdrawn $7.1 billion and markets have hardly corrected. Nifty, in fact, has risen by 8.5%. FPIs withdrew $42 billion during COVID in 30 months between January 2020 to June 22, and DIIs invested $39 billion during the same time. This shows that domestic investors have clearly taken the driver's seat despite FPI outflows. Higher bond yields in the US, cheaper equity valuations, and a stronger dollar are the typical reasons for FPI withdrawal. Historically, these factors have led to FPI outflows, but this time DIIs have provided sufficient cushion. It's the case when Indian population equity exposure is just 3% compared to the US market's 55%. This 3% equity exposure is double of 1.3% just in 2 years. Force of liquidity has just arrived in Indian markets led by domestic population. It would provide a great cushion against any volatility caused by external internal factors. Stable currency reflects many positive characteristics of the economy and policies, be it fiscal or monetary. USD INR had been the least volatile of late. It used to depreciate on an average 5% YOY between 2011 and 2018. Now it's just 3% movement YOY in last 4 years. Against Asian peers, INR is one of the best performing currencies. YTD, other currencies like JPY, MYR, CNY, TWD have depreciated by 13%, 6%, 5%, 4% respectively, while INR depreciation has been negligible at 0.6%. It was always considered a great risk that India will slip into a slow growth rate which was around 4% between 1950 and 1980 and get locked into a slow growth rate spiral. That's no longer the case. India is the fastest growing economy in the world today, ranked number 5 by nominal GDP, only after US, China, Japan and Germany. It is expected to surpass Germany in 2025, Japan in 2027 and become third largest economy by 2027. Going back to the various articles and discussions, East Asian economies like Taiwan, Korea, Singapore, Hong Kong, known as tigers, Asian economies like Thailand, Philippines, Malaysia, Indonesia, known as cubs, and China, known as dragon. All these countries have delivered fast-paced growth in the last 4 decades. I strongly believe that now the time has come for India for the elephant. This elephant has started dancing and it can go on and on for a long time. Thank you.